forward. And let me bring on board Taimur Bag, MD and Chief Economist at DBS Bank, joining in on the show. Taimur, hi, morning. I guess it's not the 75 bips hike. That was pretty much par for course. It's the commentary and the dot plot by the Fed that's kind of spooking the markets this morning. But would you say that was also completely out of the box or unexpected?
I have to confess that it was, more hawkish than we had expected. We thought that the Fed would be keen to make sure that the hawkish tone that was set by Fed Chair Powell in his August Jackson Hole remarks would be maintained. But this is going a little beyond that, especially when one looks at the dot plot. We are basically talking about at least 100 basis point upward adjustment in the near-term interest rate view by Fed governors between June and September. In the last 3 months, they have gone from looking at around 3.25% at the end of this year to now well over 4% at the end of this year. And they are thinking they might even have to hike further in the first quarter of next year. So that's a massive pivot. We have spent the last couple of hours also adjusting our forecast and our view around that because this has profound implications for asset markets, growth, and of course, inflation.
And it's a rather grim set of projections as well, right, Taimur? Because the Fed is now forcing its policy rate rising at a faster pace, higher level than expected. The economy slowing to a crawl, unemployment rising to a degree which is historically associated with recessions. One now wonders whether it's a hard landing that we're headed in for, because, the yields are clearly spooked.
There are two kinds of hard landing. One is a global financial market adjustment of a severe nature. I think that seems to be, increasingly likely. The second is a major global economic hard landing where we see outright recession in the US, compounded by recessions in Europe and elsewhere. But that, it seems to me, is still odds on likely, but not necessarily a slam dunk. And I'll tell you why. The same reason why the Fed governors are comfortable about becoming very hawkish is the fact that labor markets are strong worldwide. Whether here in Singapore or in India or in the US, we have major skills mismatch. We have massive number of vacancies available. All of that will change going forward, but would it change in such a dramatic manner that we'll be talking about negative 2% growth next year? Or will it change in a manner where we're talking about 0% growth next year? So it seems to me, especially given what Chair Powell had to say in his press conference, that a 0% growth is not going to faze him. He and his colleagues are ready to entertain the possibility of a sharp slowdown in growth, if not -2, but certainly 0.
Taimur, but what does it do to the rate cut expectation as well? Because the market was pricing in it that it is likely to happen maybe towards the end of 2023. But if you go by the dot plot now, that's going to happen only in 2024. Do you think the market is pricing that enough yet?
Well, I think, first of all, the market itself is not 100% convinced by the dot plots. The dot plots were very different 3 months ago, and now they're this, and they may again change early next year. So therefore, I don't think the market would be in a hurry to start thinking about no rate cuts in 2023 and perhaps not even in 2024, which seems to be the intention of the Fed officials. That's the guidance they're trying to give to the market. And I think I sort of understand why they want to do that. They want to keep the market sufficiently concerned about the seriousness of the Fed that the market doesn't price in substantial rate cuts next year. And consequently, we actually see an easing of financial conditions. The Fed wants to keep financial conditions tight. The Fed wants the tight financial conditions to spill over into the real economy and create consternation for employers so they either freeze hiring or start firing. The Fed wants unemployment rate to go well past 4%, perhaps toward 4.5%. For all of that to happen, it has to maintain a very, very hawkish stance and not allow financial market conditions to weaken. I think that's the game that's being played right now. The Fed wants to spook the markets. The markets perhaps are not fully convinced by the Fed, but they're getting there.
And Taimur, how unnerving is it going to be for the markets with Powell out and out saying that a recession is possible, particularly if the Fed has to keep tightening aggressively?
So I think that it is unnerving to some extent. but I'm not going to expect to see major global market mayhem like the way we saw on the taper tantrum phase. First, we have already had quite a bit of adjustment in the markets. Secondly, the market is not fully convinced that the Fed is going to be able to credibly engineer a recession and hold rates at 4%, even when millions of Americans are losing their jobs. So the view is that there's always a Fed put. That when things go bad, whether it's financial markets or real economy, even if inflation is not at a comfortable level, the Fed would act to support matters. I think that is still at the back of the market's views. I think another 75 basis point in November might kill that hope and expectation, but it's still, I think, there. But most important of all, the inflation trend worldwide are downward. Commodity prices, whether it is energy or food, shipping costs, whether it is moving containers from China to the US or domestic shipping costs. All of those things are coming down substantially. And when we see the major drivers of inflation fears in the US, which is wages and shelter, rent, those two things are very domestic US specific phenomenon. We don't have a massive wage inflation in the rest of the world. We don't have massive housing inflation through the rent channel in the rest of the world the way it is in the US. So the US would have to consider how important are those domestic imperatives and what it means for the rest of the world, because what happens in the rest of the world spills back into the US as well. Those issues would have to be considered by the Fed going forward.
Taimur, so great speaking with you this morning, and I'm glad that you could take time out and join in.
My pleasure.
Okay, that's the word coming in from Taimur Bag.